Most traders jump into the market with no real plan, and that's why they fail. But in this video, I'll show you two powerful trading strategies that smart traders use to catch high probability moves. These aren't random techniques, they're proven methods to help you trade with confidence and consistency. Stick around because by the end of this video, you'll know exactly how to enter, where to place your stop loss, and when to take profits like a pro. Let's get into the first strategy, and it's one of the most reliable ways to trade with the trend. The Trendline Trading Strategy. A trend line is not just a random line on the chart. It's a visual guide that helps us connect the dots between swing highs and swing lows during a trending market. Let's start with a downtrend. In a typical downtrend, price doesn't just fall in a straight line, it moves in waves. An impulse move down, followed by a pullback up, then another drop. Now here's what you need to know. The lowest point before price pulls back is called a swing low. The highest point before price drops again is a swing high. In a strong downtrend, the market continues to form lower highs and lower lows. This structure is your roadmap, and the trend line helps you follow it with confidence. When you draw a trend line connecting the swing highs in a downtrend, it gives you a clear visual of where price is likely to respect and reject. Now, let's flip the script and look at an uptrend. Just like in a downtrend, price moves in waves, a run, a pullback, then another run, and so on. The highest point before price pulls back is called a swing high. The lowest point before the next move up is a swing low. In a strong uptrend, the market forms a series of higher highs and higher lows, a clear sign that buyers are in control. To draw a trend line in an uptrend, we simply connect the swing lows along the bottom of the price action. This line becomes your dynamic support level, a zone where price often pulls back before continuing higher. Now, don't expect the market to move in perfect symmetry, it won't. But recognizing this basic structure gives you a serious edge in understanding the market flow and positioning your trades with precision. So why do we even bother drawing trend lines? There are two powerful reasons. Trend lines act as dynamic support and resistance. In an uptrend, the trend line sits below price and acts like a support level. When price pulls back to touch the trend line, it often bounces back up, showing buyer strength. In a downtrend, the trend line sits above price and acts like a resistance level. When price retraces to touch the trend line, it often gets rejected downward. But here's a golden rule. Never enter a trade just because price touches a trend line. Always wait for confirmation, and we'll dive into that in just a minute. Reason number 2, trend line breaks can signal possible trend reversals. In a downtrend, the trend line runs above price. If price breaks above that trend line, it could be a first sign that the trend is shifting upward. In an uptrend, the trend line runs below price. If price breaks below it, that could mean momentum is flipping and a new downtrend might be forming. But don't jump the gun. A trend line break is not enough on its own. Just because price breaks a line doesn't mean the trend has officially changed. That's why confirmation is key, and I'll show you exactly what to look for in the next part of the video. Now that you know what trend lines are and why they matter, let's talk about how to draw them correctly. Because when you draw them the right way, they can completely level up your market analysis. Rule number 1, you need at least 2 touches. A valid trend line requires a minimum of 2 clear touches. The more touches you get, the stronger the trend line becomes. But don't get too confident. Just because price has bounced multiple times doesn't guarantee it will do so again. Rule number 2, trends aren't always clean. Real markets are messy. Price action won't always respect a trend line perfectly. Sometimes price will break below the trend line, then close back above it. Other times, it might bounce early without even touching the line. Rule number 3, treat trend lines as zones, not exact levels. A trend line is a guide, not a laser beam. As you'll see in these examples, price often turns before reaching the line, or pierces through it slightly before reversing. The key is to be flexible. Don't expect perfection. When price respects your trend line and gives a clean rejection, that's when you may have a high probability setup. Rule number 4, don't force it. If a trend line doesn't make sense, don't draw it. One of the biggest mistakes traders make is forcing trend lines that don't align with the price structure. If you ignore clear swing points just to make a trend line fit, you're setting yourself up for confusion and bad trades. The right way? Let the market speak. Draw the trend line based on what price is actually doing, then sit back and watch how it reacts. One of the most common questions traders ask is, should I draw my trend line through the wicks, the candle bodies, or both? Here's the simple answer. Draw your trend line where you get the most touches. Let's break it down with a clear example. We're looking at a downtrend. When we align the trend line with the most visible swing points, we notice something interesting. Sometimes the line touches the tip of a wick, other times it cuts slightly through a wick to touch a candle body. And that's totally fine. The goal isn't perfection, the goal is consistency. Let's look at an uptrend example now. As we draw a bottom trend line connecting the swing lows, we apply the same logic. Wick or body, it doesn't matter. What matters is the number of meaningful touches. Now, let's dive into the trendline bounce strategy. Step 1. Identify the trend and draw your trend line. First things first, analyze market structure. In this example, the market is in a clear uptrend, making higher highs and higher lows. So we draw a trend line below price connecting the swing lows. This gives us a clean framework to spot high probability trades. Step 2. Wait for price to pull back. Price eventually pulls back to the trend line, but here's the twist. Instead of bouncing immediately, it breaks slightly below, luring in breakout traders. Then, price snaps back above the trend line with a bullish engulfing candle. This isn't just price action, it's a message. Step 3. Understand the psychology and liquidity sweep. This is where smart money steps in. That small break below the trend line, it triggered stop losses of retail buyers who bought too early. It also trapped breakout sellers thinking the trend line had failed. But once that liquidity was collected, the market reversed hard, leaving both groups stuck. That's what we call a liquidity sweep, and it's a powerful confirmation that the pullback is over. Step 4. Zoom out, use multi-time frame confirmation. Since we're trading on the 5-minute chart, we zoom out to the 1-hour chart for context. And what do we see? A liquidity sweep at a support level, also known as sell-side liquidity. This tells us higher time frame buyers are active, and there's strong potential for the uptrend to continue toward the next resistance. This gives us a confluence-based green light to take the trade. Step 5. Execute the trade. Enter at the close of the bullish engulfing candle. Stop loss goes just below the low of that engulfing candle. Take profit at the next key resistance level, aiming for a 2-to-1 reward to risk ratio or better. This is a textbook trendline bounce, powered by market structure, liquidity, and multi-time frame confluence. Now let's flip the chart and look at this example. The market is clearly trending down, forming lower highs and lower lows. So we draw our trend line above price, connecting the swing highs. This sets the structure we'll use to spot a short seller opportunity. As expected, price retraces back to the trend line, creating a potential short setup. It touches the trend line and immediately gets rejected, forming a bearish pin bar. That pin bar is packed with information. The long wick tells us buyers tried to push higher, but failed. Sellers stepped back in and slammed price down, defending the trend line with conviction. This is a clear sign that the downtrend is resuming. Just like in the bullish example, we step back to the hourly chart. What do we see? A recent uptrend has stalled, and price just formed a double top, a classic reversal pattern. Even better, we spot a liquidity sweep above resistance, where early buyers were trapped. That's a major signal that momentum is now shifting downward. We now have confluence across timeframes and a clear direction. To enter this trade, wait for the bearish pin bar to close, then enter your position. Place your stop loss just above the wick to protect yourself. Set your take profit at the next key support level, aiming for at least a 2-to-1 reward to risk ratio. Now let's move to the next trading strategy, RSI Divergence. This powerful technique helps you spot early signs of a reversal, even before the trend changes on the chart. There are two main types of divergences you need to know, bullish divergence and bearish divergence. Let's start with the first one. Bullish divergence. It occurs when price makes lower lows, but RSI prints higher lows, a signal that sellers are weakening. Bearish divergence. It occurs when price makes higher highs, but RSI makes lower highs, showing that buyers are running out of steam. Let me walk you through exactly how to trade this RSI divergence strategy, step by step. On the 5-minute chart, look closely at what's happening. Price is making a lower low, but the RSI is printing a higher low. That's your classic bullish divergence, a clear sign the downtrend is losing momentum and buyers might be stepping in. Divergence alone isn't enough. We need price action to back it up. And right here, we get it. A bullish engulfing candle forms. That's your confirmation that buyers have taken control. Now that everything lines up, it's time to take the trade. Entry, at the close of the bullish engulfing candle. Stop loss, just a few pips below the low of that candle. Take profit. At the next key resistance level, aiming for a 2-to-1 reward to risk ratio or better. Now, what if we could make this strategy even more powerful? By combining RSI divergence with smart money concepts, you're not just spotting reversals, you're trading with precision and filtering out the false signals that catch most traders off guard. Let's break this down with a real chart example so you can see exactly how this strategy plays out in the market. Price approaches a clear resistance level, breaks just above it, then immediately snaps back below. This is a textbook liquidity sweep, a trap set by smart money to trigger breakout buyers and stop losses from early short sellers. The goal? Gather liquidity for a reversal. Now take a look at the RSI. While price made a higher high, the RSI printed a lower high. That's your bearish divergence, a clear sign that momentum is fading even as price appears strong. At this point, you have two powerful clues: a liquidity trap just above resistance, signaling manipulation, bearish divergence, signaling weakening momentum. When these two align, you're looking at a high probability short setup. Let's zoom out to the 1-hour chart to get some context. What do we see? Price is stuck in a range-bound market. It just got rejected from a supply zone. That higher time frame rejection confirms your short bias. The path of least resistance is likely downward, at least in the short term. Now let's plan the trade. Entry: at the close of the candle that falls back below resistance after the sweep. Stop loss: just above the wick of the candle that broke out. Target: the next support level with at least a 2-to-1 reward to risk ratio. Why this setup works? Because RSI is not used alone. It combines divergence, liquidity traps, market structure, and multi-timeframe confluence. This approach eliminates retail noise and aligns with smart money behavior. That's a wrap on today's video. If you found value in this strategy, make sure to like the video, subscribe to the channel, and hit the bell so you never miss another powerful trading setup. Thanks for watching. I'll see you in the next one.